Summer 1928, you pour $10,000 into soaring stocks. You hear about the booming stock market and decide to put all your money into promising stocks of the time. The Roaring Twenties was a period of incredible economic growth and excess, but it also saw dangerous speculation and risky behavior that led to one of history's most catastrophic financial crashes, Black Tuesday in 1929. Let's dive into how this economic boom turned into the devastating Wall Street crash of 1929. By the end, you'll understand why the Roaring Twenties were not just a period of prosperity, but also marked by significant financial risk and instability. In 1928, the stock market was soaring. The Dow Jones Industrial Average hit an all-time high around 300 points by September, compared to just 60 points at the start of the decade. If you had invested $10,000 in stocks during this period, your investment would have grown to about $24,500 by mid-1929, a huge profit. But here's where things get tricky. What happens next? The Roaring Twenties saw extraordinary economic growth and a skyrocketing stock market. The Dow Jones Industrial Average increased over fourfold from 1921 to 1929 as people bought stocks and real estate on credit fueled by easy loans. Now let's talk about the volatility of this period. In the late 1920s, many investors used margin trading, borrowing money to buy stocks in hopes of big returns. This practice magnified both profits and losses. Imagine borrowing $5,000 from a bank at low interest rates and investing it in stocks expected to rise sharply. By mid-1929, your total investment would be significantly affected by market performance. If the market continued climbing, your profit could soar. But what if it did? In late 1928, banks encouraged speculative behavior with easy credit and margin loans. This led to stock prices rising not due to company improvements, but because more people were buying stocks on borrowed money. Problem: when the market inevitably declined, many investors found themselves heavily leveraged and unable to meet their margin calls. Banks called in their loans, forcing desperate investors to sell off assets at significantly reduced prices. So let's go back to our $10,000 investment. What if you borrowed another $5,000 on margin? By mid-1929, your total investment would be around $15,000. If the market continued its upward trend, you'd see significant profits. But if it started to fall, here's where things get dangerous. In October 1929, just as you feel like a genius for your investments, the market starts to wobble. Stocks begin dropping sharply. If you had $15,000 invested in half on margin borrowed money, brokers would demand repayment if your portfolio fell below a certain level. This forced many investors to sell quickly at whatever price they could get. The initial dip in September 1929 created panic among investors. As more people tried to cash out, the market dropped further. By mid-October, the Dow Jones had plunged from over 381 points down to around 230 points, a loss of nearly one-third of its value. Let's go back to our $15,000 investment. By early October, it might have been worth only about $7,000 due to the sharp decline in stock prices. That's a significant hit even before considering interest on your margin loan. The crash was exacerbated by lack of regulation and oversight. Banks were permitted to engage in speculative activities with minimal supervision, leading to widespread overleveraging among individuals and institutions. In 1929, there were no regulations limiting how much banks could lend for margin trading or requiring disclosure of associated risks. This meant many investors had little awareness of the dangers involved until it was too late. Millions lost significant portions of their life savings as stock prices plummeted below loan requirements. People who borrowed to invest saw portfolios severely diminished, often losing more than they invested due to forced sales at fire sale prices. The aftermath was devastating. Unemployment rates climbed sharply, businesses collapsed, and the Great Depression set in. Economy to fully recover from this financial crisis. Investing in stocks is inherently risky, but taking on excessive debt to speculate can turn that risk into catastrophic loss. The 1920s taught us about the dangers of easy credit and unchecked speculation. But let's not forget the positive side. Despite the crash in 1929, the 1920s were also a time of incredible economic growth and innovation. New technologies like radio and automobiles transformed daily life, and mass production increased wealth for many Americans. After the stock market crashed in 1929, people started questioning their investment strategies. Realizing that relying on borrowed money to speculate was dangerous led to reforms like the Securities Act of 1933 and Glass-Steagall Act of 1934, aimed at protecting investors from risky practices. So let's recap. The market boom in the 1920s was fueled by easy credit and speculation, leading to an unsustainable bubble that burst catastrophically. This crash led to reforms preventing similar crashes in subsequent decades. Now here's a forward tease. What if I told you history tends to repeat itself? Let's talk about why market bubbles still form and how they can be identified early on. Stay tuned. The 1920s were marked by both unprecedented economic growth and a devastating market collapse, highlighting the importance of cautious investing and recognizing speculative bubbles fueled by easy credit. After Black Tuesday in 1929, people realized relying solely on borrowed money to speculate was dangerous. This led to significant changes in financial regulation designed to protect investors from excessive risk-taking. But here's the twist. Despite these reforms, history shows market bubbles and crashes can still occur due to complacency or emerging forms of speculative behavior. So how do we recognize warning signs today? Let's dive into some numbers again. 1928, the Dow Jones Industrial Average was around 381 points, a record high. But just 1 year later in 1929, it fell to roughly 240 points, an astounding drop of nearly 1/3. Imagine investing $10,000 at the market's peak and watching your portfolio dwindle down to less than half its original value within months. The impact on individual investors was staggering. But the real pain came after. Many found themselves owing money due to margin debt, forced to sell off assets at fire sale prices, suffering losses greater than their initial investments. So let's consider a hypothetical scenario. What if you had $10,000 and instead of investing it all in stocks on margin, you put half into an index fund that tracks overall market performance? How would your potential returns differ? An index fund buys shares across a wide range of companies, performing more steadily over time. By mid-1929, an index fund might have grown from $5,000 to around $8,000, reflecting broader market growth before the crash. But after 1929, an index fund would likely fall but recover more stably compared to individual stocks hit harder by volatility. By mid-October 1929, your margin-invested portfolio could be worth around $7,000 or less. But if you had put half in an index fund and the other half in individual stocks, you'd still have about $5,500 to $6,000, significantly less but more stable. The key lesson: while stock markets can offer significant short-term gains, they're often riskier compared to a diversified approach like investing in index funds over the long term. Proper diversification and caution equip your portfolio better for market downturns. Now let's talk about broader economic impact. When the market crashed in 1929, the ripple effects were felt across industries and society. Unemployment surged, businesses shut down, and millions saw their savings evaporate overnight. Imagine if you had put $10,000 into real estate instead. While it wouldn't see the same short-term gains as stocks, property values would generally be more stable over time. By mid-1928, a house costing around $5,000 might appreciate to about $6,000, reflecting modest but steady growth typical of real estate investments. But here's where it gets important. When the market crashed in 1929, real estate values didn't plummet as sharply. So if you had invested half your money in property and kept half in index funds, by early 1930, you might retain a substantial portion of your investment, far better than a margin-invested portfolio. This highlights the importance of diversification. Spreading investments across different asset classes protects against sudden market downturns. While this strategy means missing out on short-term gains, it offers greater stability and risk management over the long term. Now let's circle back to regulatory changes after 1929. In response to the crash, Congress enacted several significant financial reforms designed to prevent future speculative bubbles and crashes. One of these was the Securities Act of 1933, which required companies issuing securities to provide crucial details. This enabled investors to make informed choices. But here's a forward tease. Despite these safeguards, history tends to repeat itself. We saw another major crash in 2001, dot-com bubble, and again in 2008, subprime mortgage crisis, and we're currently observing boom and bust cycles in the cryptocurrency market. So how do we recognize warning signs today? Stay tuned as we explore why financial bubbles still form, and how understanding them can help you make informed decisions. In summary, the Roaring '20s taught us a critical lesson. Easy credit and speculative behavior lead to unsustainable growth and economic crises like the 1929 crash. This period highlighted the importance of regulatory reforms in protecting investors from excessive risk-taking and financial instability. So let's consider this. Although we now have better safeguards than in 1929, financial bubbles still occur due to investor complacency or new speculative instruments. By recognizing these warning signs, investors can safeguard their portfolios against similar risks today. But here's a forward tease for you. The next big question is, how do we recognize the signs of the next market bubble before it bursts? Stay tuned as we explore this topic in our upcoming video. Tomorrow on the Money Files, affordability of prescription drugs versus housing costs. This is educational and historical, not financial advice.